Hello and welcome to TK Services. So this video is on public demand, I'd say. So I've got several requests from my students asking me to upload a video on preparation of financial statements. So this particular video falls under the larger ambit of the subject accounting. And mind you, this is a very basic course, essentially for people who are learning how to prepare financial statements. Could be in the BCom, BAF segments, people doing executive MBA and who are actually from the non-finance background, maybe those who are pursuing PG in the HR specialization, marketing specialization, and those who have not enough background on accounting would ideally benefit from this particular video. So let's move ahead. In terms of the coverage, I will be teaching how to prepare a profit and loss account, how to compile a balance sheet, and also ending with the preparation of the cash flow statement. Now, before you actually move ahead, let's take a quick look at what each of these terms mean. So the profit and loss account is also called as the income statement. This is the statement which it's like for a student, it's just like a report card. So it tells you how the student has performed during the year. Same way, if you extend that to a company's perspective, it's a report card in terms of how the company has performed during that particular year. It tells you the total incomes, the total expenses, the revenues and the costs, and the profit that the company has made during the year. It has two critical components, the top line and the bottom line. The top line is the sales revenue, and the bottom line is the profit, which most of the managers seek throughout the financial year. Second, in terms of the balance sheet is the statement of financial position as at a particular date. So it's like your closing balances of all your assets and liabilities. It tells you the position of the organization or the legal entity in question. And the cash flow statement is basically a statement which is prepared with the objective of marrying or reconciling profit and cash. So let's quickly, therefore, move to the problem statement. So I will read out the problem statement to you. X Limited is into the business of pharmaceuticals. It has the following balance sheet as on 31st of March 2019. So if you see here, they are asking you to refer to the Excel sheet. So let me quickly take you there. So this is the Excel sheet and this is the opening balance sheet as of 31st of March 2019 for X Limited. Please don't be fussed about the format of the balance sheet. I know this is not in the vertical format. This is not in the prescribed Schedule 6 format. But the idea here is not the format. The idea here is to learn to prepare the balance sheet. So let's not get too fussed about the format. The format is simple. If you know the content, you can fit the balance sheet in any format and size. All right, so let's go back to the problem statement. So during the current year, it procured medicines worth rupees 1400 crores. Of the total inventories accumulated, they managed to sell 80% at a margin on selling price of 25%. The fixed assets representing pharma equipment were procured 10 years ago with an anticipated useful life of 30 years, and the company has adopted the straight line method of depreciation. However, they were not happy with the productivity of the machines and hence sold this machine at the beginning of the year at a price of rupees 800 crores as a buyback option to the OEM. The OEM is the original equipment manufacturer, and this was in exchange of a new high-end technologically enabled machine priced at 2000 crores, having a useful life of 25 years. The said outlay was financed by fresh term loans carrying 6.5% annual interest obligation. The company also incurred OPEX, which is operating expenses, of rupees 40 crores in cash and made investments amounting to rupees 50 crores at the end of the financial year. The company was able to collect its past dues in entirety and also 70% of the current year's invoices. So was the case with the trade payables. The income tax assessment order for the previous year was honored with a liability settlement of rupees 90 crores. Corporate taxes are to be provided at 30%. So this is the problem statement, ladies and gentlemen. So now let's try and start with the preparation of the financial statements, and I will start with the profit and loss account or the income statement for the financial year 1920 beginning April 1st, 2019, ending 31st of March 2020. So here you go. So this is the P&L. Okay, so I'll just expand this size a little bit for you so that it's more readable. Here you go. Yes. So let's start with the revenues. Now, how will you get the revenues? If you look at the problem statement, it tells you that inventories worth 1400 crores were procured during the year. So you first need to go and find out how much is the opening inventories. If you look at the opening inventories were 400 crores. On top of that, we have bought another inventories of 1400 crores. So total makes it 1800 crores. And out of this 1800, 80% of the inventories were sold, which is nothing but 1440 crores. So the total COGS, or the cost of goods sold, is essentially 1440 crores, right? Now, what about the profit margin? It is given that the profit margin is 25% on selling price. So let us assume that the selling price is 100. So the profit margin is 25, and therefore the cost price comes out to be 75. So if you look at the profit margin as a percentage of cost price, it comes out to be 25 by 75, or 1/3, which means a 25% margin on selling price translates to a 33.33% margin on the cost price. So I take 1/3 of this COGS as my profit margin, which is 1/3 of 1440, which comes out to be 480 crores as my profit margin, and my selling price or sales value becomes the addition of both, which is 1920 crores. You can check it. If you take the percentage of the profit margin to the selling price, it comes to 25%, so which is what the problem requires. So that's your revenue. You reduce your COGS, you get your gross profit of 480 crores. Now, look at the problem statement again. It says that the company was not happy with the machinery that was procured earlier, and hence they bought back this machine at a price of 800 crores, which means you need to go back and check what was the written down value of the machine as at the end of 2019, or the beginning of the financial year 1920. If you look here, this machine costed 1500 crores, accumulated depreciation of 500 crores. So the written down value of the machine is 1000 crores. Now 1000 crores basically is your WDV, and you get actually 800 crores with respect to this machine, which means you have incurred a loss on sale of the fixed assets of 200 crores. You have surrendered or given 1000 crores worth machinery to the OEM, and OEM has given you 800 crores rupees in cash, right? So 200 crores is your loss on sale, which I will record here as loss on sale of assets. Over and above that, the problem statement also mentions that the company has incurred 40 crore rupees as part of operating expenses, which I will reduce, and I get my EBITDA, earnings before interest, taxes, depreciation, and amortization, of 240 crores, assuming that depreciation is not a part of the OPEX mentioned. Now, the new machine costs 2000 crores, right? And the useful life of the new machine is given to be 25 years. So here's how I get the depreciation and amortization figure of 80 crores, leaving me with the EBIT of 160 crores, which is 240 minus 80. So I have now reached the operating profit or the operating income level of 160 crores of EBIT. The next part of the P&L should be finding out the interest. So let's go back to the balance sheet. If you look at the balance sheet, the company already has a source of debt as debentures, 150 crores carrying 8% annual interest obligation. 150 crores into 8% is 12 crores, which should be the interest on the debentures, as you see here, right? Then it also has term loans, 50 crores carrying 7% annual interest obligation. 50 crores into 7% annually gives you 3.5 crores interest obligation, which I write here. 7% term loans, 3.5 crores interest. And remember, this year the company has also financed the new asset. Now here's where we need to do a little bit of calculation. So the old asset fetched 800 crores, and the new asset was worth, or the new equipment was worth 2000 crores, which means when you are going for a buyback, so do you go to the OEM and you say that the new machine costs 2000? Okay, how do I pay the 2000? So the OEM tells you, we'll reduce the 800 crores, which is my payable to you for the old machine that you're giving to me, and therefore you need to pay me a net of just 1200 crores. So 1200 crores is what you need to arrange from the term loans, the new term loans which the bank has given to you at 6.5% annual interest obligation. So 1200 crores into 6.5% annual interest obligation works out or translates to 78 crores of annual interest. So if you add all these three together, you get an annual interest obligation of 93.5. So if you reduce the interest obligation, you get a profit before tax of 66.5 crores. Now we are left to the provisioning of taxes. Now look at the problem statement very carefully. The problem statement says that the income tax assessment order for the previous year was honored with a liability settlement of rupees 90 crores, and corporate taxes have to be provided at 30%. Now, if you look at the last year's provision, it was a provision of 100 crores which was to be settled this year, and this year the order came to be 90 crores, which means I have a 10 crores surplus provision after I pay the income tax liability of the previous year. Mind you, I have a 10 crores surplus provision lying in my books of accounts after payment of income taxes. Now, ideally, on 66.5 crores, I have to pay 30% taxes, which is 19.95 crores. But do I really need to provide 19.95 crores, removing this from the profits as an income tax provision? The answer is no, because you already have 10 crores as surplus lying from your previous year. So you will reduce as provision for tax only 9.95 crores, reducing the 10. If you look at the formula here, I have taken 30% of the profits as your income tax liability minus the 10 crores already lying as a surplus, leaving you with an income tax provision of only 9.95 crores. And if you reduce the provision for taxes, you get your profits after tax of 56.55 crores. With this, ladies and gentlemen, you have already kind of drawn up the income statement for X Limited for the financial year 2019-20. Okay, mind you, the interesting thing about this video is you will not need to pass any journal entries, no debit, no credit, no association or relationship, or no reference to the golden rules of accounting. It is pure application of business sense, and any person aspiring to learn accounting can look at this video and try and make up the financial statements by simple application of business sense and prudence. Now we come to the closing balance sheet, given that we have already prepared the P&L. So let me expand this for you. So I will start first with the fixed assets. So if you remember, the old fixed assets were sold by the company. So these were sold. These were the old fixed assets. This was sold at a price of 800 crores, if you remember. So this gets wiped off because we have already charged the 200 crores of loss to the P&L statement, and we have now taken in new assets or new equipment of 2000 crores, and we have charged 80 crores of depreciation, assuming a useful life of 25 years given in the problem statement. So the written down value of the new medicinal equipment that the company has purchased is 1920 crores, which is nothing but the gross block minus the accumulated depreciation. Now, the company has also made investments during the year of 50 crores. If you look at the problem statement, it tells you very clearly that the company has made investments amounting to 50 crores at the end of the financial year. So if you look at here, I have put this down as investments because these will now form part of the balance sheet as of 31st of March 2020. The company also has investments worth 50 crores in their kitty of assets. Now we come to the current assets. We start with inventories. Now if you remember here, we had opening inventories of 400 crores. If you can look here, and we procured inventories worth 1400 crores, so that makes it 1800. We sold 80% of it, which was your cost of goods sold. If you reduce that, you are left with the closing inventory of 360 crores. I'll come to the cash and bank a little later. Let's start with the debtors and creditors. Now, for the debtors and creditors, let's look at this small box that I prepared here. Restrict your eyesight and your mind to this box for the moment. So I have the opening balance of 250 crores. Where is this coming from? It is coming from the opening balance sheet. If you look here, I had an opening balance of sundry debtors of 250 crores, and I also made sales of 1920 crores. So refer back to your P&L. You will see we have made sales of 1920 crores, which is an addition to the receivables from your customers. Now your customers have paid you the entire opening balance and 70% of the current year's invoices, as the problem statement tells you. So I have taken the formula here. I have taken the entire opening balance as a receipt and 70% of the current year's sales invoices as the collections. So I get a collections of 1595 crores. So closing balance, ladies and gentlemen, will be the opening balance of the receivables plus the sales made to them during the year minus the collections, that is minus the money that our customers have paid us during the year. That should be the closing balance, that is 576 crores, and that is what should appear in the balance sheet as of 31st of March 2020. Now let's move forward to the creditors balance. Now if you look at the creditors balance, the opening balance of creditors for this year was 200 crores. So I go here and I plot the opening balance of 200 crores. Now please restrict your eyesight and mind on this particular box. So 200 crores of opening balance for the creditors. I made purchases of 1400 crores. You clearly remember in the problem statement, inventories worth 1400 crores were acquired during this year. Okay, and out of that, we have paid the entire closing balance and 70% of the current year's invoices. If you remember, the problem statement says that the same thing was done with the creditors, whatever we did with the customer, right? So we paid them 1180 crores, and what is left is a closing balance of 420 crores. So here you go. So I put my closing balance as 420, which now leaves us and brings us to the point of provisions for tax. Remember, you had a 100 crore provision in your provision for income tax account, out of which you paid 90. So 10 crores remained as a surplus in your provision for tax account, and during the year you transferred 9.95, which means at the end of the year you have a 19.95 crores tax provision in your balance sheet, representing 30% of the current year's profits before taxes. That completes the provision for taxes. So now I come to the finally to the cash and bank statement. So all I have done is I have put all the items that were transacted in cash during the year. So we have the opening balance of 350 crores, which comes from the opening balance sheet. If you look here, the cash in bank as on 31st of March 2019, which is the opening balance for the financial year 1920, is 350 crores. So that's my opening balance. I collected 1594 crores, which is what is coming from here. That is your collection from the debtors. I paid 1180 crores to my vendors, which is coming from here, and OPEX of 40 crores was paid in cash. If you can see here, it is there in the OPEX. We have paid 40 crores, which we have charged to the P&L also. Okay, investments worth 50 crores. You can see we have already recognized the investments on our balance sheet, which means we have invested in cash, so we have reduced that from the cash balance. Interest of 93.5 crores, which is clearly visible in your P&L account, and taxes of 90 crores which were paid pertaining to the last year, right? So that is the total payment. So if you add the opening balance with the collection and you reduce all your payments, you should get the closing balance, which you can see as a part of the formula. I've added these two and reduced all the payments to arrive at a closing balance of 490.5, which is appearing as a cash and bank balance here, right? So that completes the asset side. And now we move to the liabilities. We have already done the current liabilities and provisions. So now I move to long-term debt. My 8% debentures remain unchanged. My 7% term loan remains unchanged. All I have here is the 1200 crores of the new term loan that I have taken to finance the net capital acquisition. And what about the share capital? That remains unchanged, but the reserves will change. If you look at your retained earnings as of beginning of this year, this was 500 crores. During the year, the company made a profit of 56.55 crores. So if you add that to the 500 crores of opening balance, you get 556.55 crores as the closing reserves and surplus. So that, dear friends, completes the balance sheet. Now, if you add these items as a part of liabilities, it comes to 3396.5. Add these as a part of your assets, it comes to 3396.5. So if you look here, the liabilities, the sum of the liabilities is equal to the sum of the assets, which means your balance sheet is absolutely correct. So that completes two important financial statements, the P&L and L and the balance sheet. And now, dear friends, I'll come to the last one, which is called a cash flow statement. So what does the cash flow statement intend to do? Let's look at that first. Now, profit and cash are different things. You can have certain non-cash adjustments in your P&L, which you need to rewind in order to arrive at your cash position. You can have certain accruals. Okay, so when you make these adjustments, you can arrive at the cash balance during the year. And so, therefore, the cash flow statement marries or reconciles the profit and the cash. So, it's quite logical, therefore, that we start with the net profit for this particular year. Now, we just saw that the net profit for this particular year was 56.55 crores. But when you arrived at this net profit, there were some non-cash adjustments in your P&L, which reduced your profits but not your cash balances. And those were the taxes of 9.95. This was a provision you made, so non-cash adjustment, a depreciation adjustment of 80 crores, and a loss on sale of assets of 200 crores. So I add all of these back here, 9.95, 80, and 200, because these are non-cash adjustments. Interest I have added back because if you look at the net profit of 56.55 crores, it is after deducting interest. Interest, however, is not an operating expense. It's a financing expense. So I will just add it back here and reduce it in the cash from financing activities. All right. So if you add all of these here to your net profit, you get the operating cash before working capital adjustment. Remember, the cash flow statement consists of three important segments: cash from operating activities, cash from investing activities, and cash from financing activities. Operating activities basically are the activities which relate to the day-to-day business transactions. Investing activities could be investments in, when you make investments or investment in subsidiaries, or you buy equity shares, or let's say you buy new fixed assets, all of these, or you sell fixed assets, all of this will be a part of the investing activities. Financing activities, as the term suggests, comprises of all those transactions which are incurred to finance the business. So it could be new borrowings or it could be repayment of the old borrowings or sources of funds. Right? So now we are at operating cash before working capital adjustment, which you have seen is 440 crores. So let's look at the inventories actually. So inventories, the opening balance was 400 crores and the closing balance, that means the opening balance as on 1st of April 2019 was 400 crores. Closing balance as of 31st of March 2020 is 360 crores. That means the inventory balances have come down by 40 crores. Now this in essence represents a 40 crore receipt. You will only have a reduction in liabilities, a reduction in the inventories when there is a stock movement outwards. There is a net stock movement outward, which means cash has come in for the inventories that you have sent out. So any reduction in current assets is therefore a cash receipt. Any increase in the current assets would be a cash outflow. So in that context, I will add delta inventories of 40 crores because that is a decrease in the current assets. Whereas your debtors, which stood at 250 in the beginning of the year, stood at 576 at the end of the year. So there is an increase in the current assets, which I just told you is a cash outflow. So I'll record that as minus 326. Creditors, now look at the liabilities. When the liability balances increase, it's just the other way around. When the liability balances increase, they represent cash inflow, which means we have more cash held on behalf of others. All right, so that is an increase in the cash. So if you look at your liability, it was 200 crores as per the opening balance sheet, 420 crores as per the closing. So there is an increase of 220 crores in the creditors. Now if you add all of these up, it comes to 66 crores net outflow. If you reduce from 440, you come to the operating cash before taxes of 374 crores. Remember, during the year, we also paid taxes of 90 crores pertaining to the previous financial year, which is classified as an operating activity. When you reduce that, you get your cash from operating activities of 284 crores. All right. So now let's move to the investing activities. So the first investing activities that comes to your mind is the investments that the company made. If you look at the closing balance sheet, we have made investments of 50 crores, which I have also reduced from the cash balance here. So that is clearly a cash outflow in the investing activities. Remember, we had also sold assets worth 800 crores, so that's a cash receipt. So that is a plus, and we purchased new assets of 2000 crores, which is a cash outflow. So if you add all of these up, you get 1250 crores of cash from investing activities. Now, interest. Now we move to the last part, which is the financing activities. We have completed operating and completed investing. Now let's move to the cash from the financing activities. If you remember, interest is just a reclassification. I removed it from the operating activities. I added it back here, right? And now I'm reducing it to where it should be reduced. It is a financing activities. We are paying interest because we have sourced the funds in the form of debentures and term loans and financed a business. So this is a financing activity, and hence it will be classified as a financing activity, and it will be reduced from here. Remember, we had also taken a 1200 crore term loan to finance the net excess that we had to pay to the OEM to finance the new plant and machinery or pharmaceutical equipment. So that is also a receipt because we have taken a new term loan. All right. And we took this 800 crores. We got it from the old asset. We took a loan of 1200, that makes it 2000 crores, and we spent 2000 crores in buying a new asset. So this 1200 crores is also a plus. So your total cash from financing activities comes to 1106.5, which I will represent here. So now if you add all these three activities, cash from operating activities, investing activities, and financing activities, you get your net cash generated during the year. We had it for you. If you look here, it is 140.5. So this is the net cash that the company X Limited generated during this financial year. Now, the company must be having an opening cash balance. So let's look at that. If you look at the opening balance sheet, it had a cash balance of 350 at the beginning of the year. During the year, it generated 140.5. So if it had an opening cash balance of 350 and if it generated 140.5, it should logically have a 490.5 closing balance, which is a summation of these two. Let's go back to the balance sheet as at 31st of March 2020 and see if it is 490.5. There you go. If you look here, the cash and bank balance is 490.5, and that is what is appearing as per the cash flow statement, which means your cash flow statement is also accurately prepared. So therefore, this brings us to the end of the video, ladies and gentlemen. So all the people who are still struggling with concepts relating to how we should prepare the P&L, how we should prepare the balance sheet, how we should prepare the cash flow statement, which is prepared for what objective, this video will get you going. I hope you enjoy the video. Please do ask me any questions by putting your comments on my YouTube channel where you will be watching this video, and stay tuned for more videos on my YouTube channel, Concept Canvas. Happy learning. Thank you very much.